Welcome back to Trade 360. Time now for our 360 round. For that, I want to bring in our panel to discuss bank earnings. We've got Caleb Silver, the editor-in-chief of Investopedia, and John Petrides, portfolio manager at Tocqueville Asset Management. Thank you both for joining us today to dive into these latest results. All right, so we had out the gate, first up, JPMorgan Chase. They did beat on both the top and bottom line. I don't think people are surprised by that. Profit total $4.96 a share on an adjusted basis. Revenue coming in at $45.68 billion. This stood out to me. Jamie Dimon's the CEO saying that the economy remained resilient in the quarter, but he always, he talks about the tailwinds, but he always has this, kind of a little bit of a pessimistic slant. And he cautioned about the headwinds like tariff and trade uncertainty. What's your reaction to that?
I agree with you. He's usually a little bit more pessimistic. I thought there was a little more optimism, and maybe he and the bank are surprised at how well the consumer has held up, because that's one of the things he pointed to: consumer resiliency. A lot of account opens at Chase at the retail bank. Trading and investment banking activity, that's been perking up. If you're a bank right now in that sector, you're watching a volatile market here, you're watching a melt up of asset classes. Good place to be if you're JPMorgan Chase. But net interest income, that really puts could put the stock under pressure and the company under pressure, because rates will come down eventually, no time soon, but eventually they will.
Yeah, look, and speaking of net interest income, of course, Wells Fargo, that was a flag for Wells Fargo. So, John, I'm curious to know your assessment and some of your takeaways from the results we got out today, whether we're talking about JPMorgan Chase, Wells Fargo, or Citigroup, which Citigroup has gained today off the back of their numbers. They had strength in a variety of segments.
To zoom out and look at the bigger picture. Look, if you go back to almost 1 year ago, almost to the day, the banks have been amazing performers, particularly the larger cap banks, on a lot of strong tailwinds. And the stocks have performed very, very well as a group over the past, 2 months, call it. And if really want to go back over the past year. So I think a lot of good news was priced in. So I'm not overly worried about the stock's selling off a little bit today in general, based on what expectations are versus where the street was at, because they have been such strong performers. I take a look at, if you didn't own banks or financials today, and you're still scarred really from the great financial crisis of these are black boxes, what do we, why should we invest in these? My question is, what else more do you want? Right. So now you have deregulation. You saw some acquisitions today or mergers on the regional bank front today. You've seen companies are returning shareholder value to shareholders. You have a positively sloped yield curve where the shorter yields are less than longer dated, which is good for banks. Loan growth is still low single-digit type stuff. These banks are investing in AI to help on the efficiency to make their businesses run more efficient. So if you're not owning banks because of the fears out of 2008, 2009, what else more do you want to get you into the space? And I still think that the banks in general, particularly the larger cap banks, are still attractive from a valuation perspective despite the sell-off today.
Okay. Caleb, I want to go back to the point you mentioned about the consumer. Citigroup CFO highlighted the consumer on their earnings call, saying that the consumer's been remarkably resilient. They also had this more than 20% jump in banking revenue. They had this rebound in IB and M&A activity. They were part of the Circle IPO as well. How much of their future activity hinges on this renewal in IPO activity, and especially, you also have that headwind risk that Jamie Dimon mentioned, the macro front and clarity on tariffs? Yeah,
well, right now, and John's right, if you're not entertained by these results, I don't know what you're waiting for, but there is a split between the retail banks and the investment banks, and you can see it in just the year-to-date returns. Investors are favoring the Goldman Sachs of the world, the bigger banks that are doing institutional trading. M&A activity is perking up again. IPOs are perking up again. We've seen a couple of big ones down here at the stock exchange. Retail banks under a little bit more pressure because of that consumer exposure. Consumer hasn't cracked yet. Will they eventually? We got the inflation reading this morning, 2.7%, still relatively benign. Delinquencies for all the important things we're watching, credit cards, mortgages, car payments. Those are up, but not anywhere near where they were during the great financial crisis or a few years ago. So the consumer is relatively healthy, but investors are favoring the big banks that are doing the big banking activity.
Okay, the consumer
Can I make
is
a comment?
relatively healthy. Yeah, John, go ahead.
Yeah, can I make a comment about JPMorgan, about Jamie
Go
Dimon
ahead.
in particular? Jamie Dimon there's no one smarter than Jamie Dimon, and he has the highest respect of all the banking CEOs. And when Jamie Dimon speaks, the world listens. But it's very important to understand and put Jamie Dimon's context into Jamie Dimon's words into context. Being the CEO of the largest bank in the world, his job is to manage risk. So when Jamie Dimon says something, we have to watch tariffs, or interest rates could go higher or could lower. It doesn't mean it's 100% guaranteed that that's going to happen. It just simply means that there's a chance that that may happen. And when he says it, I find it very important, because right now we live in a very complacent world. So if Jamie everything seems to go up and to the right. So if Jamie Dimon throws out risks out there, it's very healthy for the average investor and his associates to realize, look, there is still possibilities that this or that can happen. And it's always important for investors to understand that and put it in context, that all he's saying is that there's a chance that such and such may happen. It's probably not 100%. It's not 0%, but where does it fall in between there? And that's what I think investors have to come to appreciate when Jamie Dimon speaks.
Okay, now great perspective there, and essentially the point, my takeaway there is the upside takes care of itself. You have to acknowledge the downside. All right, we'll have to leave our conversation there. That's John Petrides of Tocqueville Asset Management and Caleb Silver, editor-in-chief of Investopedia. Thank you both.